If you've sold some crypto, you probably know you need to declare it in your tax return. But what happens if you've bought multiple parcels of the same coin? How do you select which one you've actually sold? This is called selecting your inventory method, and it is one of the most important things you can do when it comes to saving tax on your crypto profits. Let me explain the different inventory methods you have available to you and how you can select the best one for your situation. So there are various different inventory methods to choose from, but to understand how these work in reality, we need to do an example. So let's say we have purchased some Bitcoin. We've purchased one Bitcoin. Let's go with 3 different dates. We've purchased one Bitcoin on the 1st of January 22 for $65,000. Now I'm talking Australian dollars here. We've purchased one Bitcoin on the 1st of January 2023 for $24,000 and another Bitcoin on the 30th of June 2024 for $91,000. Now we decide we want to sell one Bitcoin. So on the 31st of December 2024, we sell one Bitcoin and we sell that for $150,000. So we've sold this one Bitcoin, but how do we know which one of these Bitcoins we've sold when it comes to tax? So what we can do is look at these different methods and how they would work in reality. So let's first look at the FIFO, or the first in, first out method. So under this method, it's very simple. Whatever asset you purchase first is the one that you have sold. So in this case, we would have the $150,000 sale, but we'd be selecting that Bitcoin we purchased on the 1st of January 2022, which was $65,000. So in this situation, we would have a capital gain of $85,000. And the great thing is this has been held for over 12 months. So we'd get a 50% discount, so we'd only pay tax on half of that. So our taxable gain would be $42,400. Now let's look at the LIFO, or the last in, first out. Now, as I'm sure you can imagine, this is the opposite to the other method we just talked about, because we're going to now select the latest asset that was purchased, the last asset. So in this situation, we'd have a $150,000 sale. We'd be selecting the last time we purchased Bitcoin, which was the 30th of June 2024 for $91,000. So the $150,000 less than $91,000, leaving us with a capital gain of $59,000. So this obviously sounds great. It's less than the $85,000 in the first in, first out method, but we haven't held this one for over 12 months. So we're getting no 50% discount. So therefore, we're going to pay tax on the full $59,000 capital gain. Now, another method that you might choose is the HIFO, which is the highest in, first out. Now, in this situation, because we only had 3, it's quite simple. And the highest in is actually going to be the last in, so our calculation will be same as that method. So you might always think that, well, I want to choose the highest, or I want to choose the latest because the prices kept going up, so that's always going to be a higher figure. But the risk with just choosing the highest figure is that if you haven't held for over that 12 months, you're not going to get that 50% discount. So in this example, we would probably want to go with first in, first out if we were just selecting between these methods, because it's going to optimize for the 50% discount. Now, let's assume we had used the first in, first out method, and we now went and sold another Bitcoin the next day for 150 grand again. So in this situation, we've got our sale of 150,000. Now we're using first in, first out. So we've now got to use the one that was on the 1st of January 2023, which was only 24,000. So in this case, we have the 150,000 less the 24,000. So therefore we have a $126,000 gain. But of course, we've held this one for over 12 months, so we get that 50% discount, which is going to mean that the total taxable gain of this one is going to be $63,000. So clearly you'd want to use a method that optimizes your overall situation, which means you would probably want to individually select which asset you had sold. Now, this is very simple if you only have the 3. We could continue to pick and choose which one works best for us. However, you're a crypto investor. I know it's likely you've got way more than 3 transactions. So the only way you can really start to solve this on a bigger scale is with crypto tax software, which I'm going to go into next. But first, I do want to plug something, and that's my email newsletter. So every single week, I send out a newsletter to everyone on the list. It's grown to over 500 of you guys. And I send it out and I give you tax tips, business tips, and just a general update on where I'm at with things. I'd love for you to subscribe. The link is in the description to this video. Now let's jump back into talking about how you can use crypto tax software to best optimize your inventory method. So what I'm going to do is show you an example of how you can do this through crypto tax software. I'm going to use crypto tax calculator as an example. It is my favorite tax software to use when it comes to crypto. I do have an affiliate link in the description where you can get a bit of a discount if you're interested. But you can see here, it's quite easy to toggle through different methods. So we do have that first in, first out, our last in, first out, our highest in, first out. They do give you an average cost method, and we have a most tax effective method, which I'm going to talk about soon. But you can easily toggle through and do these calculations at a grand scale rather than having to do them manually. It's definitely going to be a big time saver, and if you're not using some type of crypto tax software, I'd highly recommend you look into getting one. So let's look at this most tax effective method and how that works and how that could be your best option. So what the most tax effective method does is it looks at multiple different things in an order to optimize for your taxes. So what it's going to do first is look at short-term losses and then long-term losses. So these are going to be positions that you hold where the cost base is higher than the sale price. Therefore, it wants to use them up so you can recognize those losses now. Then what it's going to do is be quite clever and use long-term gains first. So it's still going to look for the highest cost base amongst them, but using the long-term gains so you can get that 50% discount. Then it will move on to your short-term gains. And again, it's going to still look for the highest cost base of that particular class of those short-term assets. So you can see this is a much better approach than just using first in, first out or last in, first out in most situations. The biggest thing with the inventory method, it's all going to depend on what your long-term strategy is, what your short-term strategy is, and what you're trying to optimize for. That's why you need to understand how each method works and how it will affect your own situation. While most tax effective is probably going to work for the majority of people, there might be situations where one of the other methods works better for you. Like I said, manually selecting would probably be the best method for everyone. But if you've got 1,000 transactions, that's going to be very hard to do. So software is definitely great, but the biggest risk is if you go and toggle and change these methods after you have lodged a tax year, you're going to be changing all of the transactions unless you do the lock dates. So Crypto Tax Calculator does allow you to lock dates. So once that's locked, if you change the method, it's not going to change what you've claimed historically. And that is very important because if you change the method and you don't do that, what it's going to do is change all the prior transactions. So if we switch from last in, first out to first in, first out, and you haven't done that, all of a sudden, you're going to be potentially using the cost base of something you've already used the cost base for previously, which is obviously a big no-no if you get audited. The best thing to do with the softwares is play around with them, see how they work, understand the inventory methods, and understand how they line up with your long-term strategy. Another part of your long-term strategy is thinking about how you can save tax in various different ways. In this upcoming video, I'll go through some of my favorite strategies that you can put in place to help save tax on your crypto profits. I thank you for watching this one, and I hope to see you over there.